Hi, I'm Dave.
And I'm Paul.
And we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul. How you doing, bud?
What's up, man?
Nothing. I'm just trying to stay inside and stay cool. It's that time of year.
Yeah, you said it was like 105. We're always talking about the weather around here, like two old dudes.
Weather and haircuts. Hey, your hair still looks good, by the way.
Yeah, starting to fill in a little bit. You know?
Yeah, your scalp is fading. Good. Well, hey, let's start off with a question. I'm going to ask you a question, and then we're going to get to the point of this question later on throughout, towards the end of this podcast. But let me ask you a question, Paul, and anybody listening. Let me ask you the same thing. Would you rather save $112,000 or earn $411,000?
I'd rather have the 411, obviously.
Okay. Obviously, right? It's pretty obvious. And I think most people listening would say, well, yeah, of course, all else being equal, I would rather have 411 as opposed to save 112.
Right.
Then why do so many people do exactly the opposite of that? So what we're talking about here is this topic is near and dear to our hearts because it really fires us up. And because the public has been misled by so many people for so long, and it's just, it's flat out wrong how they're being misled. So what we're talking about here is, should I get a 30-year mortgage or a 15-year mortgage? So, Paul, why do some people promote the idea of a 15-year mortgage?
So, really, it's about the overall interest savings over the period of the loan, whether it's 15 or 30 years. You are going to pay less overall interest to the bank if you do a 15-year note. And that is very alluring to people who, these are the folks, and I used to be one of these guys. I had a 15-year note on my first house after I had refinanced a couple times, right? And we've talked about that before. But at the time, I couldn't think of anything more productive to do than to pay off my, I think it was 2.75% or 3.7, whatever it was, mortgage, right? I couldn't think of anything else to do with the money. So I was like, I might as well pay down the note so I could save on interest. Right?
There's old Paul. That's old Paul.
That's voice. Old Paul. Yeah, that's like Captain Paul.
I like what you just said without even realizing it. I think you said, I couldn't find anything more productive to do with my money. Dude, that's spot on. And that's what we want to get to is, hey, you have the choice to do different things with your money. You have the choice between a 15 and a 30. But let's take a deep dive into this conversation and determine what is the most productive use of those dollars. You could use the exact same dollars to do two different things. Now let's dissect this and find out what's the most productive use. And like if you care about the productivity of your dollars, then you'll want to pay attention to this. And for many people, maybe you have a 15-year mortgage. And like Paul said, he had one at one point before he learned a better way. I never did, but not because I was necessarily opposed to the idea. I just didn't want the bigger payment. So I guess I was just lucky in the sense that I decided against it back years ago. So like you said, Paul, you're going to pay more interest. That is a fact. You will pay more interest to the bank over the life of a 30-year mortgage than a 15-year mortgage. Boom. If that's all you look at, that's the only variable you look at and only angle you come from, which is what a lot of these financial entertainers do, is they give you one variable. They don't talk about the rest of the story because that'll just muddle things up and prove them wrong. They're going to give you one variable and say, this is the way to do it. There's no other way because of this. Look, it's math. It's simple. It's obvious. You're stupid if you don't do it. Right? So we put together a little example here. And Paul, you can talk through the numbers here we're going to diagram this for you. And then you can follow along through a video link, a YouTube link that we'll put in the comments that'll walk through this as well. But let's talk through these numbers right here. Like, you got that page up with the 300,000 at the different
I do. I just
okay.
pulled it up actually.
Okay.
So I'm looking on your video on this screen. So okay, so you have a guy or gal.
Let's give him a name. Let's give him a name. Mortgage Guy. His last name is Guy.
Mortgage Guy, right? Mortgage Guy has these two options. He's got these two scenarios going on, right? So you have a $300,000 mortgage, right? The 30-year is 3.5% in this example. So this was from a year and a half ago or whenever you made it. Monthly payments $1,347. Total payment over that 30-year note would be $484,966. Then his other option would be, hey, mortgage guy, you could do a $300,000 mortgage at 3% for 15 years. The monthly payment's $2,071, so over a $700 difference between the two as far as monthly cash flow out, leaving my personal economy. Total payment over the life of the loan, 15 years, $372,913. Right, so less overall money going to the bank, right, to the mortgage company.
Yeah, $112,000 to be more precise, less that he's paying to the bank. So, yeah.
So that seems on the surface no brainer. Let's do the 15-year note. I can afford the extra money every month. I might as well do that, right?
Yeah, and guess what? By doing 15-year, you get a slightly lower interest rate, typically, right? Maybe a 0.5% lower. So you get 3% instead of 3.5% in this example. So yeah, there you go. So yes, if you stop there, absolutely, 15-year mortgage makes sense if you can afford that payment. But let's not stop there. Let's continue. So
continue.
Here's a common rally chant from the financial entertainers, the very popular ones out there who are promoting 15-year mortgages for absolutely everybody. Like one size fits all. There's no reason anybody should ever get a 30 if you can get a 15. This person also says you can get a 12% annual return in the stock market. So it doesn't take much. Like all you had to do was make it through maybe like 8th grade math to do this yourself. And you can get out a little financial calculator, but I did all the math for you in this video. So just go to the very end. I show you all the calculations and everything. It's legit. Well, let's say instead of mortgage guy, instead of getting the 15-year mortgage, he gets the 30-year mortgage. And with that $724 difference that he's saving, because it's that much less, right, than the 15-year payment would have been every month, he instead takes that $724 and puts it into the stock market where financial entertainer says he's going to get a 12% annualized return. So Paul, what is that number after 15 years? How much did mortgage guy make in the stock market?
Sure. So just to reiterate, 15 years, every month I'm taking $724, investing it in mutual funds.
Yeah.
And I'm getting 12% without interruption. I'm going to have $344,574.
Okay. And then so he did the 30-year mortgage, right? Took the difference in the payment from the 30 to 15 and put it in the mutual funds, got $344,000 after 15 years. What's the remaining balance on his 30-year mortgage after 15 years?
It's $188,000.
So you're telling me he's got $188,000 remaining on the 30-year mortgage, but he was able to earn $344,000 in the market.
Yes.
Are you guys seeing what I'm seeing? So what if
you said that in the video too.
Yeah, just like that. So if he wanted to pay off his house after 15 years and own it free and clear, he could simply cash out $188,000 worth of stock and pay off that mortgage, right? And how much would he have remaining in the stock market at that point?
Whatever the difference is.
Yeah, you got to keep going. But the difference is $156,000.
There it is.
So he would, at the end of 15 years, using the exact same dollars, he just prioritized where those dollars are going, found a more productive place for them. At the end of 15 years, he not only has his house paid off, he has an additional $156,000. So
that sounds way better.
So if you can do that, and this entertainer's that emphatic about, yeah, you can get 12% return, why would he not tell you to do that? It just doesn't make any sense to me. Like,
right.
He should tell you to do that, and then look how much better off you might be. But let's say, Paul, 12% sounds kind of stupid. Like, let's just be reasonable here. Let's cut that in half.
Sure.
6%. Let's say you only get a 6% return in the market on that money over the 15 years. What are you going to have after 15 years?
About 20 grand left over if you did the same thing.
You'll have,
correct?
Yeah, you'll still be able to pay off your house, pay off the remaining mortgage, and still have $20,000 remaining. So, I mean, if you're pretty confident you can get 12% in the market, you ought to be 100% sure you can get 6%, right? So there you go. Why would you not do that after seeing the numbers?
I don't know. There's really no good reason other than no exploration on our own. We just take everything at face value, and he's got to be right. He's on television and he's rich, and he sells a lot of books and a lot of courses, right?
Yeah.
But the numbers simply don't lie, right?
They don't, and
it's compelling.
I think, and I was surprised. I had actually never sat down and crunched the numbers myself until I put this video together, and then it just fired me up so much that I just put it all presentation together and recorded a video and put it on YouTube like within the same day, because it blew my mind how much more productive your dollars can be going somewhere else.
Yep.
So, yeah.
But if you did the latter, if you did his method, right, you're making the wheels of the banking business, specifically the mortgage business, go round and round even faster.
Right. Who convinced us to give our money to the bank faster than they require it? Who convinced us that was a good idea to give up more of our liquidity, more of our capital quicker than we have to a bank that cares nothing about us, that would kick us out of our house if we missed the final payment on a 15-year mortgage?
Right. I would argue, you're making it easier to foreclose on, right? Because I'm probably sacrificing liquidity maybe to do this, right? To get out of debt, pay it off faster. I'm making it. I'm the bank's exposure. Every payment I make is smaller and smaller and smaller.
Right.
Right. So by year 13, man, if something goes bad, I lose my job because of a pandemic maybe, and the government shuts down the economy, or maybe I get injured or something and I can't work. They don't care how much equity you have.
Right.
Until that note is paid off, you do not own that house.
You don't own that house. And man, it's sad when the pandemic hit in 2020, people lost their jobs. Luckily some people had forbearance that was put in place, but I don't know how many people took advantage of that or how that actually worked once that forbearance was canceled and they had to catch up on their payments or whatever. But yeah, you've signed yourself up for 15 years of spending $724 more than you needed to, that could have been used for life. Like, you're going to have emergencies in life, right? Think over the last 10 years. Has something completely unexpected happened in your life in the last 10 years that you didn't plan on, that you never were able to foresee? I can think of multiple events that rocked my world in the last 10 years that, I can't imagine why anybody would plan on these things. But
right.
But they happen.
The future's unknown. It's almost like the future's unknown.
It's almost like the future's unknown. Yeah, almost. So, and that's a great point. You could be 14 years into a 15-year mortgage. Pandemic happens. You can't make your payment. Boom. The bank can foreclose on you. They can take your house. How happy are you going to be that you're stuck with a payment that's 30, 40% higher than it needs to be every month, when you actually need access to that cash to fund a life emergency, to handle life in general?
Right.
Yeah. That's that there's no security in paying your house off early in my book.
Right. I think some people call it prepaying your mortgage. We are not advocates for that.
Not advocates of prepaying your mortgage. Absolutely. Because there's something more productive you could be doing with your money.
No question.
Now, if you could only earn 10% on your money and mortgage rates were 15%, then yeah, that's probably the most productive thing you can do with your money is get rid of that 15%
Right.
interest that you're paying, because anything else you would only be able to earn 10%. And that wouldn't make any sense. But that's not how our economy works. It's really not.
No.
Yeah. I mean, that's a great point. There's a couple other things to consider here too. Think about inflation. Like, everybody knows the effects of inflation. The effects of inflation are rising prices and everything, and the fact that you have to spend a lot more of the same, like, to get the same thing, you got to spend a lot more dollars for it right now.
That's right. The mysterious basket of goods that drives the CPI calculation, right? They keep changing what that is.
Yeah, well, it certainly doesn't include food and gas.
It's right. It's completely ludicrous. I wouldn't believe any this 8.9% or 9%. I don't believe any of that.
It's outrageous. You can do the math yourself. Anything from when I go to Aldi, you got to get a paper bag. You got to buy those. They've jumped 30%. Like, it's only 3 cents. They went from 10 cents to 13 cents. That's a 30% jump. And it's in everything. Everything. Almost everything except bananas. Bacon's $8 for 12 ounces.
And it's 12 ounces now. It's no longer a pound of bacon. It's 12 ounces of bacon. So there's been shrinkflation on bacon the last, I don't know, maybe 5 or 10 years.
You think we'll see shrinkflation in everybody's waistline too because of that?
Well, some things shrink with age, but not your ears and generally not your waistline.
Yeah, ears, nose, and waistline. But let's get back to the point I was trying to make. $1. Think of how much could you buy for $10 30 years ago? You take $10 to McDonald's 30 years ago. I can tell you, I worked at McDonald's 30 years ago, almost. It's like 28 years ago I worked at McDonald's, my first job. A value meal cost $3.19. That was
right,
including tax. It was $3.19. I know that by heart. 30 years later, how much is a Big Mac meal? It's like $8 or $9 at least.
It's not cheap.
Tripled. It's probably tripled.
It's a $40 family of four, $40.
Easy, but it's tripled. Now take that same dollar today that you're putting towards your mortgage and think, if you could capture the purchasing power of that dollar today for the next 30 years, how valuable is that?
Immensely.
You're basically, what you're doing by locking in a 30-year mortgage is saying, the dollar I'm paying, or the value of the dollar right now is going to buy just as much of this house 30 years from now as it's buying today. Where else can you do that? Where else can you capture the value of a dollar for 30 years?
I know a place.
Yeah, well, we'll talk about that. We'll get to that, of course. But imagine that. So
yeah,
that's another thing to think about, is that 25 years from now, when you're paying that $2,000 mortgage payment, that's really going to feel probably more like $1,000.
That's right.
Right? Because of inflation. It's not going to feel like that much money. So, having that hanging over your head, big deal. Now, there's something to be said for people they want to have their house paid off by the time they retire. One less thing to worry about.
Yep. No,
and
no doubt. There's value.
Yeah.
There's value there, right? If you're not paying that $2,000 a month mortgage anymore, you're, in theory, you're $2,000 a month wealthier.
But what if, Paul, would you say there's the same value in having your home paid off as there is in having the ability to pay off your home?
No, that's an excellent point. So I'm in the camp of maintaining the ability, and my clients and I, and we always talk about this. I like to maintain the ability to pay things off. Right. So I've got a couple of, I've got 2 mortgages. I have a new car payment that I didn't have before. I could pay some of those things off, but I don't want to. I want to maintain the flexibility and maintain the ability to pay the things off, but I want to maintain my liquidity for those unforeseen things that occur in the unknown future.
And productivity of those dollars. Is that the best use for those dollars? Yeah,
Right.
you might owe debt to somebody, but guess what? Wealthy people have debt. It's not necessarily consumer debt like, the rest of us schmucks might have, right? But they leverage it. They say, well, hey, I'll pay 3.5% for 30 years gladly so I can take the difference, that's $724 a month, and go earn 6, 10, 15, 20% on it over the same
Right.
amount of time.
Yeah, so it's one of those things, opportunity cost, right, Dave, that Nelson always talked about. You have to tie some sort of cost to that capital, right? The dollars
Yeah.
you no longer have use of, what is that costing you by stuffing it into that 3%, 3.5% mortgage, right? You don't know, but I would tie at least a 10%, I would tie 10% to that.
Yeah. Yeah,
I
at
could have
least.
earned 10% every year on that, and now I can't.
Yeah. I mean, there's places you can earn 10% without breaking a sweat.
Yep.
And, I, I'm happy to share with you what I do with my own money if anybody's interested. But so when I asked you, I said, is there a difference between having the house paid off and having the ability to pay the house off? For me, it's a mind shift change. Like, because people say, I want peace of mind. I don't want that debt hanging over my head, something I have to do. So I would ask you, okay, whether you have the house paid off or you have the ability to pay the house off today, if you choose to, it's the same thing, is it not?
I think it's the same thing.
Yeah.
Knowing that I could pay these debts off, I have a great warm and fuzzy. But I know, in my personal example, there's either better opportunity that I can use that money with,
Yeah.
or in my case, I've got some, as you know, I'm going to retire from the Army the next couple of years, and I want to build my dream home.
Yeah.
And I want to have the ability to build it the way I want, when I want to build it. So
Right.
that's my personal scenario. So, but yeah, if I need to pay off the Hellcat, I'll do it.
Yeah.
But I'm not going to.
All right. Good. Well, so let's talk about what you and I would do with the difference. Mr. Buy term, invest the difference. I don't know why he doesn't say get a 30-year mortgage and invest the difference, because that's extremely beneficial.
It's the same concept too.
It's the same concept, only this one makes sense. So
Yes.
so let's get back to the original question I asked you. I asked you at the beginning of this, and everybody listening, would you rather make $411,000 or save $112,000? So we already determined that 112 that you would save is by, the interest you wouldn't pay the bank if you got a 15-year mortgage. You're saving 112. But talk to us about, where does that 411,000 come from?
So what I did in this scenario, and I just did this right now, is I took is it $724?
Yep.
Okay, so
Per
that's
month.
$8,688 a year.
Okay.
Is my math correct? Okay.
Sure.
So what I did with that is I built a scenario around a 40-year-old man, standard health rating, like most people are, and I built a specially designed dividend-paying whole life insurance contract that you could use when you're implementing the infinite banking concept, as taught by Nelson Nash. So, at year 18, you want me to get into this? At year 18,
Yeah.
that policy will likely have $200,000 of cash value.
Which is
12,000 more
well, but that 188 number was at year 15.
at year 15, excuse me.
So-
yeah, so right. So a few years later, just by putting the same difference into a dividend paying whole life insurance contract, right, we've got the ability to pay off the house. So instead of paying it off in year 15, we're able to pay it off in between year 17 and 18.
Yeah, it's probably like year 17. So yeah, think about that. So you could put your money into something that's guaranteed and build another asset for yourself. So at the end of 17 years, you have the ability to pay your house off. Now, what I would propose to everybody is that if you did this method at the end of 17 years, you wouldn't want to pay your house off, because you would have something more productive to do with that cash value than use that to just pay off a 3.5% mortgage.
Yes.
So,
and we can't illustrate that on a piece of paper, but what has this person implementing this scenario, what is he doing with all that capital that he's accumulating in his own dividend paying life insurance contract? I don't know what he's doing with it.
yeah, well, we can only assume, if we want to compare apples to apples, he's just putting it away and not touching it, not thinking
Sure.
about it, like he would with a 15-year mortgage, putting it there and having no access to it.
Sure.
However, the difference is, if an emergency happens, if hard times hit, if he loses his job, pandemic hits, and everything gets, government issued shutdown of commerce, this guy is going to have tens of thousands, maybe hundreds of thousands in his cash value that he has immediate access to if he needs it to get through anything.
That's right.
That he wouldn't have. You think he's going to be able to go back to the bank and say, I've been paying you for 13 years. I got 2 years left on my mortgage. You have $280,000 of my equity inside that home. I need some of it. They're going to say, get in line, pal. Oh, and by the way, you just told us you need it. Therefore, we are not going to give it to you because we only give,
That's right.
we only give money to people that don't need it.
That's exactly right. Oh my goodness.
Yeah.
Yeah, man. It's great. Control, liquidity, use of the money, equity. This is all wrapped up into this product. So
yeah. So I think it's important that we laid out the facts and we laid out what your alternatives are. And we do that not to judge somebody. Like, hey, if after seeing all of this, you still want to go get a 15-year mortgage, and maybe that fits into your overall financial strategy, go for it. But there's an opportunity cost. You can't say yes to that. By saying yes to that, you're saying no to something else. So I think it's important that we reveal what you're saying no to and what could be. So you got to know, look at things from every angle. Don't take one person's word on it and just one perspective on it. Explore it.
You know what I've found to be true, Dave, now that, I've been doing IBC for several years, and I know you found it to be true, is, and we've talked about this in past episodes, you just when you're sitting on liquidity, and large amounts of liquidity, you start to see opportunities, and then opportunities are attracted to you. And then, people always ask, well, how did you get started doing whatever you're doing? And it's like, well, it started with Dave, and then it led to this guy, and then this business, and then this business, and then, right, and it spreads like brush fire.
Yeah.
And that's that attraction. Capital is attracted to opportunity, and opportunity is attracted to capital, right?
Yeah.
And then you start looking. You're looking at the landscape of the world, the financial world, totally differently than you would be if you were just dumping all your money into the bank at a 15-year note that you don't need to be paying back faster than the bank wants. So anyway,
Absolutely.
Bottom line, 30-year note every time.
Every time. We don't want to say one size fits all, but the numbers work the same for everybody.
Why
Math
not
is
do
math.
the 30-year? And if you want to pay it off faster, just make extra principal payments.
That's easy to do, and some people do that. It's
very simple.
You could still make the same back, and maybe it's even, I haven't run the numbers, but maybe that's even more advantageous because then you're knocking down more principal instead of front loading the interest on the loan.
Right.
You know?
Maybe
that's better than a 15-year mortgage. Get the 30.
Those
and pay
amortized
extra.
loans. They're such a mystery.
Yeah, they get you, and then they get you to refinance after 3 to 5 years and start the whole thing all over again.
Oh my goodness.
But for cash flowing properties, maybe it works because you just care about the cash flow. But so folks, look at every angle, explore every angle, and if you're upset because you just got a 15-year mortgage, in the last year or something, I remember showing my video to somebody, a friend of mine, and he's like, man, I wish I would have seen this a month ago. I just got a 15-year mortgage.
I remember that.
Yeah.
I talked to a lieutenant colonel that I had just met in passing that had done the same thing and has owned the house for a while, and showed her the video, and she's like, yeah, it's a great video. It makes sense, but I'm still proud of my decision. And I was like,
Well,
great.
yeah,
Good for you.
sure. But to each his own or her own. So
All
there
right,
you
Tammy
go.
just said dinner's ready.
Yeah, Hannah just got here with dinner, so I'm
Perfect.
hungry. I'm out of here, man.
All right, brother.
All right, we'll see you next week.
See you, bud. Bye. Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.